Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Today is Tuesday, July 7th, and I thought I'd come to you with a brief market update. The S&P 500 right now is at about 3170. That's down about 25 basis points today after being up about 5.7% over the last 5 trading days. So we're giving a little bit back here, but everybody should feel pretty good about where we've come from. Today, ostensibly, the market is trading off a little bit because we saw a little bit weaker industrial data out of Germany, at least a little bit weaker than people had hoped for. Germany is looked at as obviously a bellwether out of Europe. They are probably Europe's largest economy. And they have had very, very, very low virus activity for a while. Their efforts at social distancing have been incredibly effective at halting the spread of the virus. And I think people are maybe a little bit disappointed that they haven't seen stronger growth as a result of lower case counts. That said, yesterday we got quite a large uptick in the market based on some comments out of the Chinese government about supporting their market and the necessity of providing the market with liquidity to basically drive returns there. And that, I think, drove equities globally higher because obviously China is the world's second largest economy. So it's nice to see their government stepping in to support economic activity there. The number one question that we get right now is, how is it possible that the market's up 5.5% over the past 5 days when all we've seen is increasing data around in number of cases, increasing infection rates, this and that and the other. And I think it's really driven by 3 factors. The first that we talked about before is what's probably more important at this point in terms of economic activity is the rate of hospitalizations and deaths versus the actual number of people that have the disease. So if you go back to March, pretty much anybody who got tested had a pretty severe form of the virus and was likely to be hospitalized or at least be confined with symptoms for quite a long time. If you fast forward today with more prevalence in testing and candidly a little bit less social distancing behavior by the younger of us, you're more likely to see positive cases where the individual is sick, maybe has very mild symptoms for a day or two, and then they go away. And obviously what we care about with this virus is hospital capacity. So if you look at the trend in either deaths or hospitalizations, that trend actually looks not as bad as the media would like you to believe when they start to print numbers on record cases, et cetera. So for the economists that are following the market, that's one positive sign. The second positive sign out there is that there are certain bellwether counties that people are looking at in terms of Texas and Florida that appear to have been maybe gotten to their individual peaks. So people are looking at very sort of micro level data to try and determine, at what point do these case rates start to peak and turn the other direction. And it does appear that in certain areas, particularly hard hit areas, that there has been an increased compliance with social distancing. There has been an increased compliance with mask wearing. And that is actually acting to flatten the curve in some of the hardest hit areas. So that's good news. Last but not least, I think there's just an increasing view amongst market participants that the worst of the economic damage associated with the pandemic is behind us, that we're unlikely to return to massive large-scale lockdowns. That even if you have governors in Texas and Florida and Arizona talking about starting to shut down gyms and maybe close down indoor restaurants again, that's a very small overall economic impact relative to the economic impact that we saw in March, April, and May, where we just saw widespread swaths of the economy fully shut down. And you have to sort of offset the closures in those states with continued openings in some of the northern states and some of the larger states out west that kind of offset the economic activity that might be slowing down in Florida and Texas. So long story short, the market, I think, overall is continuing to look forward to 2021. It's estimated that, we'll know whether or not one of the vaccines will be safe and effective by late 2020, early 2021. And the market continues to be just sort of focused on that, 6 to 9 month data out as opposed to the immediate near term. So with that, as always, if you have any questions, please feel free to reach out to either myself or to your advisor. I hope you had a lovely holiday weekend, and I hope you have a great week. Thanks.